All right. Good good morning, good afternoon, and thank you all for joining us again on this week's Freight Market Roundup. And as always, I want to give a big shout out to our Director of Marketing, Vanessa Fry. Because of her and her team, we are now available to be accessed through a whole series of different platforms. So, for instance, we now have a podcast. So if you miss our weekly updates, or if you just prefer to stream us while driving in the car, be sure to shoot us an email and we will get you connected and set up because we are definitely excited about that new media option. Now, with that new medium of streaming has come a few problems. So if you tried to join us last week and were unable to, I am so sorry about that. We had a massive technical difficulty, but we are up and running. And on the topic we were going to discuss last week of the OSRA, or the Ocean Shipping Reform Act, which we were planning, we are definitely going to be covering that next week. It's an incredibly important topic. And if you're a shipper, you definitely don't want to miss this. As an added benefit, there's actually been a couple things that have happened just in the course of this week in regards to that topic. So hopefully we'll be able to bring you guys an even better show. So make sure you tune in next week as well. My name is Jason Brand. I am the Director of Outreach and Partner Development at Supply Chain Solutions. And my co-host is Anthony D'Ambrosio, our Vice President of Sales. Now, this week, Anthony is down in Panama, and he's working with a couple of our agent partners in an effort to streamline our Central and East Coast shipments even more. So get excited about the outcome of that and the next few months of ocean shipping in that realm. So this week, it's all about the Freight Market Roundup. But before we get started, and it's just a reminder for our returning guests, we do have a format we like to keep to just make sure that we're easy to follow along with. So I mentioned this earlier, but first, I'm going to run through our major trade lanes. I'm going to start with the Trans-Pacific lanes, and then I'm going to move over to our Transatlantic lanes. Finally, we're going to touch on the Suez, or our China to Europe trade lane on the opposite side of the world. Between each section, I'll try to cover a few current events that our teams are thinking about and our customers are concerned about. And after wrapping up the ocean market and ocean current events, I'll run through the air market and also what we're seeing with the fuel, so the oil and gas markets. I've got a ton of ground I got to cover. And quite frankly, I've got some notes in here that I don't even know if I'm going to be able to digest, because there is just, seriously, I know I've been saying this a ton lately, but 2023 was supposed to be the calm year. 2022 was supposed to be the year we repaired. 2023 was definitely supposed to be the calm year. And oh my gosh, we just have so many initiatives and so many things going on. It's kind of hard to, keep you guys adequately informed. So maybe we'll have to even start doing daily little tidbits or something, but we'll see about that. Let's dive right in. So first and foremost, like I mentioned above, we're going to start with the Trans-Pacific lane. So our China to US West Coast lane. And obviously it's China and Southeast Asia in general. So in the last 2 weeks, we really haven't seen a lot of change. And, from the ocean shipping portion, that's not very surprising because rates are literally under $1,000 a TEU for the ocean shipping component. And, before I dive into my feelings on that matter, let's just quick take a peek at the East Coast side. So 3 weeks ago, because remember, these averages aren't this week, they're always last week. So 3 weeks back, our averages were sitting at 2,250 a TEU, roughly. Obviously, some over, some under. Last week, our averages were at 2,125 a TEU. And remember, we're talking about the Southeast Asia, China to US East Coast ports. Now, this is incredibly low, particularly for this lane. This is a long lane. Obviously, we're extremely low on the West Coast side. Sub 1,000 is crazy, not even factoring in inflation and those kind of matters. It's just very, very low, even compared to pre-pandemic levels. But with looking at the East Coast, that's such a longer trip. And also, we still are dealing with other issues in those ports. There still is some congestion. There's more demand happening over there right now, particularly than anywhere else in the nation. And I'll get into that a little bit later. But I'm not in disbelief. And, mainly that's because, as I mentioned before, we had the TPM conference and we had a bunch of just leaders in the industry come together. And then we here in Michigan have had a lot of supply chain conferences as well. And just hearing from the business community and kind of their initiatives and their goals and what's happening with their inventory right now sort of makes sense. But let's dive into, firstly, a couple things that you've got to consider, that we are considering and we are trying to advise our customers on. So, not to be confused with the U.S. negotiations currently still going on the West Coast. Negotiations started with Canada's port workers as well. And they actually, the port workers, it gets a little bit confusing, but they're called the ILWU Canada versus our ILWU. So it's the ILWU Canada, and it's 12 locales in Western Canada, and then that plus the BCMEA. And so they represent the container lines and the terminal operators. But both parties began formal negotiations on March 6th over the new contract, which will replace the existing 5-year agreement. Since the negotiations have started on March 6th, they've had about 5 face-to-face get-togethers, and, you know, a little different from our negotiations right off the bat. They're saying things are going poorly. And we know this for a fact because they're just 2 weeks in, and the unions that are manning the ports of Vancouver and Prince Rupert, they've already asked the Canadian federal government for help in reaching a new contract. And they said specifically, we're lacking any meaningful progress. They went a little bit further than that, and they made it an official request by filing a notice of dispute with the Minister of Labor in the Ottawa region. And that triggered a process, which essentially now a federal consolidation officer is going to be appointed within 15 days. And they've got a 60-day period where if it's not extended, they have to kind of figure this out with this oversight. And going through everything we went through last year with the ILWU, 60 days feels like far too short of a time period, but we'll see. So let's keep optimistic on that. But now let's kind of take a look to the other side of the pond. So blank sailings in April from China, they have been growing, and carriers are planning to almost cancel another 50 voyages that were scheduled to depart from Chinese ports between now and the end of April. And if you look at the total TEUs, it's insane. So of those 50 voyages, it's a total of 443,000 TEUs that they're planning on blank sailing. To make this even more intense, this actually comes on top of already 47 blank sailings that were already announced, which we're going through this week in March and the third week in April. And that's less TEUs, obviously, though it's less ships, but still, this is a substantial amount of capacity being pulled. And, it is a serious concern, but the main thing we can hope for is that, demand coming back in the second half of the year to at least stabilize the need for these blank sailings. There are a lot of factors that go into this as well. Obviously, we talked about this in previous shows, but the ordering of new vessels and those vessels coming online, the timing hasn't been particularly great with the pandemic. So these ocean carriers made an absolute boatload of money, pun welcomed, and they bought a bunch of new ships. Now, the strategy for that we went over in a previous show when we were talking about the 2M Alliance. It may not be what it seems strategy-wise. Maybe it was a way for some of these carriers to split off and have their own non-alliance-based operations. But that, we still have to see how that unfolds over the next couple of years. Anyway, a lot of these ships are starting to come online right now. So it's adding to a situation of low demand, more supply. And so it's just kind of exacerbating a lot of these problems. I have a little bit more I want to talk on that, but not at this moment. So, okay, we talked about the Canada ILWU. We also talked about how there's a ton of blank sailings coming up in the next month. Obviously, a ton already happened, but a ton more are scheduled. And then I want to come back to the U.S. labor market, and I want to talk about another issue. So it's the U.S. trucking market. And it's not just the challenge that they're having of hiring or keeping workers. It's another set of contract talks. And this is between the Teamsters Union and 2 of the country's largest LTL carriers. That's ABF Freight and T-Force Freight. And these talks are underway. Their current contracts are set to expire this summer. So the heat is, we still have a ways, but the heat's definitely turning up already on this. Now, at the same time, the unions are battling their largest LTL employer, which is Yellow. And this is specifically over plans to re-engineer its network by combining terminals and lanes of some of its national and eastern regional subsidiaries. So the Teamsters began their talks with ABF Freight this week, and they started negotiations with T-Force, which was, formerly UPS Freight, earlier this month. And last week, actually, and this is nuts, there's just so much going on. Last week, the Teamsters, they forcefully rejected a proposal, and this is on that third point with yellow, and that was to prevent them from completing their reorganization, which they set the groundwork for in 2019, and it was actually set to be completed here this year. So that was forcefully rejected by the union. More to come on that, definitely in the next couple of weeks. After this OSRA show, really, we need to take a whole episode, if not a couple episodes, to focus on all of the union negotiations going on, all of the contract talks, because quite frankly, I said this in the last Rate Market Roundup, by the middle of summer, if the West Coast ILWU doesn't find a resolution, we will be in 6 different contract talks at the same time for different links in our, domestic and also obviously international supply chain when you think about, the ports. So it is going to be a very big challenge. It's going to be a very big risk for shippers, and we've got to walk through all these. But a couple new ones that I've been learning about that we need to communicate and that we've been talking about internally. Now, not to get bogged down in some of that, let's move on to our transatlantic lanes. And remember, we're just focusing on the ocean rate averages right now, and that's not including the inland portion of those shipments. And when you think about the transatlantic, we're talking about Europe, the US East Coast. I've said this in the past, and I just said this a little bit earlier, there is more demand that we're seeing in that area than the rest of the major trade lanes. It's actually one of the only trade lanes right now that is still elevated over its pre-pandemic levels. And it's been sticking there actually for a while, and it's still relatively elevated. Now that has a lot of different reasons, but it is something to think about. Now, what's going on currently is we are starting to see what I believe to be the decline that's going to lead us to that pre-pandemic point for these rates. So right now, as of last week, our rate averages came in at $3,890 per 20-foot equivalent unit, or TEU. And that's actually a solid 7% reduction over what we saw 2 weeks ago, which is the fastest reduction we've seen in this lane for over the past 2 months. So it's something that kind of throws up a little bit of a flag saying, okay, wait, something's happening here. So if you're shipping this lane, and let's say you ship this lane regularly, you're shipping via maybe a couple containers a month, our strategy to you would be use our consolidation program. And I'm pretty biased with that, but it's obviously our program. But what we love about it is it was designed around this idea of having the fewest parties involved and having the most oversight from both of those parties and eliminating unnecessary third parties. So the loading of the containers, the unloading of the containers, these are done by us and our very integrated partner, LLS. We have a regular schedule. We try to stick to it, as closely as possible. And we change carriers when necessary to make sure we can maintain a rigid schedule. It's been fantastic. And knowing freight rates are going to be lowering over the next few weeks, likely few months, if you want to meter in your freight and pay as little as possible now and wait for a better opportunity to maybe import more, this would be a great option. Obviously depends on your industry, depends on, just how your operations work, but it is definitely something to consider. It's very cost effective as well. Now, when it comes to this lane, the transatlantic lane, I hate to kick this down the road, but there are so many environmental initiatives that are going to have just massive effects on the whole shipping environment. And, quite frankly, I don't want to do it a disservice by dipping my toe in, but there is a major thing that happened the other week. And I'm just going to talk about this briefly, but in 2020, there was a goal of doubling the amount of rail usage that Europe had in its transportation network. And the goal was to hit a 30% market share of rail by 2030. They wanted to shift as much freight into the rail network. Now, when they cited this originally back in 2020, the current market share was around 16%. Right now, it's at about 16.8%. So there is a little bit of frustration that this shift has not been given the attention it needs. Personally, if Anthony was here, he'd definitely agree with me. This situation we've had in Europe has been very unique and very complex, particularly when compared to the US. And we talked about this as well. The use of feeder vessels and just the way Europe is set up, it's different. And so some of these mode shifts aren't as easily done simply because there's more domestic links that have to be reorganized to make it possible. But there's a lot of data coming out on this. They're talking about their 2030, their 2050 goals, and are they going to stick to them? How are they going to change them? So at some point, we're going to do a deep dive on that. But if you are shipping into or out of Europe, you do have to be aware there are a lot of climate initiatives. You will be affected by them at a minimum at the beginning of 2024. We're going to see some major sweeping regulations coming out regarding ocean shipping, and it's going to be a big stir up for that community, but also obviously just, Europe on ground shipping. So keep that in mind. Now, another situation, and honestly, we've got another union situation. So this happened in Germany, but members of the German transport union, EVG, they actually walked out on Monday. This is over a pay dispute, and it has had a massive effect. It effectively shut down the country's rail network. So this strike was held by unions that were representing transportation workers in Germany, and it just effectively brought everything to a standstill. So the rail operator was called Deutsche Bahn. They canceled all of their trains, and on top of this, Frankfurt and Munich airports, they stopped or rescheduled all of their flights. So EVG represents 230,000 workers, and that's just at Deutsche Bahn Rail and bus companies. And they're demanding a 12% pay increase. Now, the United Services Union, known as Verdi, they've got 120,000 workers, and they're expecting all of their workers to also go on strike. And they're demanding a 10.5% pay increase. Just to give a comparison of what's been happening, obviously a lot of these union issues have been a direct result of inflation. So currently, the Germany inflation rate is sitting at around 8.7%. So slightly higher than that inflation rate, but it's not been very steady. If you look over the course of the last year, it's been quite kind of violent in how it's changed. Now, let's move on because we have a limited amount of time. So let's discuss our last major shipping lane, and that is the China to Europe lane. Now, in the beginning, I talked about our format that we like to keep here on our Freight Market Roundup, but we had a opportunity to hear from an ocean carrier on their earnings call, and this was OOCL. They're a Costco shipping subsidiary. And honestly, they gave a great full market breakdown. It's interesting to see it from an ocean vessel operator's perspective. And do I think there is a little bit of they just have a different view of the market. Let's put it that way. But they did go over some great information. They went over a decent forecast, a little bit about the past as well. So what I want to do is kind of look at some of the highlights and the numbers specifically they're talking about. So versus going over what our averages were when we're talking about China to Europe, that shipping lane, I want to give you what OOCL was telling their investors on their earnings call. So their China to North Europe rates from Shanghai to Rotterdam were down 87%, and they report in FEUs or 40-foot equivalent units. So their average cost was $1,553, and then their Mediterranean rates from Shanghai to Genoa, they've lost 82% of their value over the past year, and now they're costing $2,256, and that's per 40-foot equivalent unit or FEU. On the transatlantic, their rates right now are around $3,704 per 40-foot equivalent unit, and they're down 42% year over year. And as a quick note, we generally report in TEUs, and a lot of the market has TEUs as their general reporting statistic. So just kind of keep that in mind that this is slightly different than a TEU. Now, bottom line of the earnings call was that OCL is enjoying a balance sheet they're calling strong enough to enable them to both withstand and essentially be effective in a challenging and cyclical market and still provide attractive returns to shareholders. So they're leaving with some optimism. They did, though, cite a lot of key concerns. So firstly, OOCL stated that this downward rate trend, it may have started to stabilize, but there are a lot of problems for that stabilization. They did note there was better load improving factors that were seen at terminals, and also when they were looking at throughput, they said their throughput had improved. The dwell times had also gone down. So all of these are good when it comes to just the health of the shipping environment. On the flip side, they said there's a substantial amount of container shipping capacity flooding into service, which we've talked about. And that could delay, and this is in their words, it could delay the improvement in the market conditions. They also talked about the International Maritime Organization, that's the IMO, and their green initiatives. They referred to it as a capacity sponge. So they actually viewed to it in a positive manner, kind of saying that, the blank sailings are obviously a way to remove capacity and try to kind of equalize supply and demand. But also this IMO green initiative and the new vessel requirements will also kind of sponge up capacity. But they specifically stated it may not be enough to exceed the amount of capacity coming in and the low amount of demand. OOCL themselves actually has a lot of ships on order or just coming into service. So they took delivery on one of 6 new vessels. That's their 24,180 TEU ships, and they were ordered in 2020. And and the rest of those 6 actually should be coming online this year. They also ordered another 7 ships at the end of last year, and they're specifically designed to meet this new fuel requirements or these new fuel requirements. So they're classified as these mega ships, and they have this dual fuel capability. So they can essentially use alternate fuel sources. A lot going on there, and it's going to be interesting to see how the earnings calls of other carriers, if they were similar, if they were kind of telling a different story, and how optimistic they are on the market as well. Now, obviously a lot going on, but let's get into air. So let's first look at our Southeast Asia and China air rates into the US. Now, I talk about this often, but there's a huge seesaw effect we see in air rates when you're shipping out of China. And last week, our rates plunged. We saw it coming in at about $3.25 a kilo. And that is down. And so that's last week from the week before, down from $6.10 a kilo. So keep in mind, when you're shipping out of China or when you're shipping air in general, time is definitely money. If you're in a situation where you can tell us or your logistics team just a little bit earlier, they may be able to capitalize on some of these market changes and kind of slip in where you can save a lot of money. Moving on to our European air shipments. And I'd like to again, shamelessly plug our consolidation program we've been running with our German partner, LLS. So if you find yourself shipping air or just small amounts of ocean regularly out of Europe, we buy space every month and we personally consolidate those shipments. So the goal, kind of what I was talking about earlier, is that the fewest people are touching and the fewest amount of third parties are involved. If there's ever an issue with damage, it's easy to resolve. With air, damage can be incredibly difficult to get to the bottom of. But if there's a situation, easy to resolve, it's packed by our team, a team that cares, because it's, quite frankly, it's your customer of ours versus a third-party packing who's not actually in direct connection with the customer. So we pack it in a way to ensure there's going to be the minimal risk for damage. And yep, LLS seals it, and we open it, and we deliver it to you. So it's a great process, and it's a good way to kind of manage some of the expensive air rates when we have them. Now, that being said, let's say you're shipping out of Europe right now. Let's say you're shipping a large amount of air. Right now, rates are pretty good. Right now, we are seeing around $2.72 a kilo, and it has been wavering a bit, but it has been heading downward. So keep in mind, air rates right now are great. Out of Europe, one of the reasons why we have the European air consolidation is there's just a great amount of capacity, and we are able to kind of pick and choose what carriers we want to use. So it's just been a very interesting market, and it's been a very exciting time to get involved in consolidation because it just offers another solution to people that are struggling, whether, with cost, even though costs have been getting better, which is great, but also with reliability. Now, let's move on to our Central and South American air shipments. So This is quite interesting. The other week, we were talking about the Central and South American air shipments, and they were pretty cheap. And I basically said, it's time to jump on them. Well, they have gotten even cheaper. We're almost seeing our lowest rates we've seen over the past 12 months. They aren't quite the lowest, but they're almost the lowest. So right now, as of last week, we were averaging $1.90 a kilo for those air shipments. And that's truly a fantastic rate. So if you are going to be air shipping sometime in the next few weeks, jump on it as soon as you can. Try to take advantage of this $1.90 a kilo. As I said earlier, time can be money, but sometimes if there is availability, you might be able to slip into one of these planes and get a fantastic rate. So keep that in mind. Finally, onto our oil and gas. And this is going to kind of be a little bit of a bright spot, but the diesel market, it's been improving week over week. And, currently we are sitting at a U.S. average of just $4.12 a gallon. And that has come a long way from last summer's highs. So I think we do need to truly celebrate, if we can actually get this rate down at the $3 point on a national average point of view. Of course, our short-term or weekly winner is the PAD 3 region, and that is the Gulf region, not including Florida. They're already in the $3 range. They're sitting at $3.88 as an average. And of course, our biggest loser, as always, when it comes to fuel prices, is California. So they're unfortunately sitting all the way up in the $5 range at $5.16 a gallon. We talked about it last week 2 weeks ago, but if you haven't renegotiated your fuel surcharges, if you're still paying the same fuel surcharges, it may be time to start that conversation. If you're having a hard time going about that, we're experts at that, and we can help you lower that fuel surcharge rates. Now, with that being said, with all of these union negotiations going on, it's going to be a little tough, but give us a call. We can see what we can do. A lot of the larger shipping companies out there, or just larger transportation companies out there, went through a series of changes in their fuel surcharge rates back in January. So if you haven't seen that, you need to reach out to us, and we've got to figure something out. So anyway, that's what we got for our show today. Speaking of switching to a new media, we had a last minute update on this new software right before, and it kicked my my marketing director out. So unfortunately, we won't be able to field questions today, but I hope you enjoyed it. Tune in next week, OSRA. It's a critical topic. And if you are a shipper, demergent detention is it's like a cuss word. So hopefully we can get that under control. Thank you all, and make it a great day.